It was just another morning in New York City, the hum of traffic mixing with the distant blare of delivery trucks. Coffee cups steamed in the hands of early commuters, and the skyline glimmered as the sun began to rise over Wall Street. People scrolled through their phones, checking stock prices, their portfolios, and news feeds. Because for most Americans, the stock market wasn't just numbers on a screen. It was their retirement, their savings, and for some, the foundation of their very lives. Then it happened. A sharp ping echoed from phones and computers across the nation, not a cheerful notification, but the kind that makes your stomach drop. The headlines screamed in unison. U.S. stock market plummets 50% overnight. Dow Jones, S&P 500, NASDAQ, all down half their value in a single historic crash. Imagine that. You're in Chicago, sipping your morning coffee, checking your brokerage account, and suddenly the number you trusted with your financial future has halved. Half of your savings, your investments, gone, or at least temporarily vaporized. Across the country, in Los Angeles, Miami, Houston, and Boston, Americans experienced the same panic. Every portfolio, retirement account, college fund, and investment vanished into uncertainty overnight. People panicked. Calls flooded brokerages. Lines formed at banks. Social media erupted with messages like, "My 401k is gone, and what do I do now?" The psychological impact hit faster than the market itself. Fear spread quicker than any algorithmic sell-off. Now, before we dive into exactly what this would mean for your money, your city, and your life, take a moment to hit that like button, subscribe to Merger Oblivion, and comment where you're watching from. New York, Los Angeles, Houston, or somewhere else. I want to see which city is most affected if this nightmare were to unfold. Because here's the truth. A 50% stock market crash isn't just numbers on a screen. It's a chain reaction that could collapse trust in the entire financial system, instantly affecting banks, credit, mortgages, and everyday spending. Let's walk through what happens next. In Manhattan, traders on Wall Street were already frantically calling clients. Panic algorithms kicked in, selling off stocks faster than human hands could keep up. Hedge funds tried to stabilize positions, but with every passing second, the market bleed grew deeper. Margin calls hit investors, regular Americans, not just Wall Street tycoons. Suddenly, credit lines froze, loans became unavailable, and brokers advised clients to hold cash. But cash itself was not enough for the transactions that fueled America's economy. Over in Los Angeles, small business owners stared at blank screens. Wire transfers failed, credit card processing slowed, and payroll systems shut down. Employees called, worried if they'd be paid. Suppliers delayed shipments because their own accounts were impacted. Restaurants, stores, and tech startups faced immediate liquidity crises. The ripple effect spread from individual accounts to businesses to municipal budgets. Imagine you live in Houston. Your mortgage payment was set to auto-debit today. The market crash triggered bank freezes on automatic transfers as institutions assessed systemic risk. Your mortgage lender calls. They can't confirm payment today. Utility bills? Same story. Auto loans? Delayed. Even your city's public services risk disruption if tax revenue flows are delayed due to investment losses tied to the market. In Miami, retirees who rely on dividends for monthly living expenses panicked. Their monthly income dropped to nearly half, as stocks they depended on for interest and dividends suddenly plunged. Seniors, families, and single parents alike struggled to understand. In an instant, their financial stability evaporated. And it wasn't just individuals. Municipal bonds, pension funds, and insurance companies felt the impact. Cities like San Francisco and Seattle, with high-tech-driven economies, saw public funding freeze because investments backing these projects lost value. Hospitals, schools, and local governments were suddenly in crisis mode. As chaos spread, federal institutions scrambled to respond. The Federal Reserve convened an emergency meeting. Liquidity measures were announced. Banks were instructed to suspend panic-driven selling. But trust, once broken, is hard to restore. Americans don't just care about numbers, they care about certainty. And in the face of a 50% market collapse, certainty is gone. Social media amplified fear. Twitter, TikTok, and Reddit exploded with live updates from panicked citizens, financial analysts, and influencers predicting even further collapse. Hashtags like stock market crash, Dow down 50, and financial collapse trended nationwide. Americans across all 50 states were watching the disaster unfold in real time. You might be thinking, surely the government will step in immediately, right? Here's where the cliffhanger hits. Emergency measures take time. Even if the Federal Reserve injects trillions in liquidity and Congress passes stabilization bills, the sheer scale of a 50% drop means the effects are felt instantly. Markets can rebound over weeks or months, but personal accounts, loans, and investments might not stabilize in the same way. Now imagine being in Boston, where tech startups rely on venture capital. Investors freeze funding because their assets lost half their value overnight. Entrepreneurs cannot pay employees, tech products halt, and the innovation ecosystem stalls. A crash isn't abstract. It affects real lives, families, and businesses minute by minute. I walk through this scenario not to scare you, but to illustrate a truth most Americans ignore. The stock market is the lifeblood of modern U.S. financial infrastructure. When it stumbles violently, the consequences ripple outward, hitting banks, loans, pensions, everyday transactions, and ultimately the average citizen. Even in Los Angeles, where gig economy workers rely on instant payments from companies like Uber, DoorDash, and freelance platforms, the flow of funds could freeze. Apps fail, bank accounts get temporarily locked, and people are left without access to the money they depend on to pay for essentials, rent, groceries, gas. And that's just the immediate aftermath. A prolonged crash of 50% could trigger a cascade across global markets. Europe, Asia, and Latin America would feel the ripple. American exports slow, imports spike, and global investors panic. The US dollar, normally considered stable, might wobble. International credit markets tighten. So what does that mean for everyday Americans? Stock-based retirement accounts drop. 401ks and IRAs lose value instantly. Banks may impose temporary withdrawal limits as liquidity is assessed. Credit card limits might shrink. Interest rates could rise. Small businesses could face immediate bankruptcies due to frozen accounts or disrupted payments. Government intervention will take time, and even with measures, confidence may take months to restore. At this point, panic isn't just financial, it's psychological. Fear drives irrational behavior. People hoard cash, line up at ATMs, and delay purchases. Cities like Chicago and Houston see empty grocery shelves as panic buying begins. Gas stations might not accept credit cards. Everyday life grinds to a halt. Now, before we go deeper into how this unfolds over the next 72 hours and what Americans can do to survive or protect themselves, I want you to hit that like button, subscribe to Merch or Oblivion, and turn on notifications. Drop a comment below telling me your city and how prepared or unprepared you think you'd be if this happened overnight, because what comes next is even more terrifying. It's the domino effect of banks reacting, companies pausing operations, and the government scrambling to prevent a full-blown economic panic. We'll explore that in Section 2, revealing the hidden dangers most Americans don't even realize are looming beneath their money. And what steps could save you if this nightmare becomes reality. The sun was dipping below the skyline of New York City, but the chaos showed no signs of slowing. Lines outside ATMs were now blocks long, with people clutching smartphones and paper wallets alike, trying desperately to access anything that could function as liquid cash. Social media updates came in waves. ATM down in Manhattan, no withdrawals allowed. Credit cards declined in Chicago. Wire transfers failing across Houston banks. In Los Angeles, small businesses were shuttering doors early. Employees were sent home unpaid. Contractors couldn't be compensated. And vendors demanded cash upfront for deliveries that were never going to happen. The normal rhythm of the American economy had hit a dead stop. Streets, normally buzzing with commerce, now carried a tense, almost eerie silence, punctuated only by the occasional honk of frustration. Meanwhile, in Washington, D.C., emergency meetings were underway. The Federal Reserve, Treasury Department, and White House advisors worked frantically to prevent total financial collapse. Emergency liquidity injections were planned, temporary suspensions of trading implemented, and regulatory measures rushed into effect. But even as these steps were announced, the fear had already spread nationwide. Confidence, once lost, isn't restored with a few official memos, and Americans felt it immediately. Families in suburban Boston were checking bank balances in vain. Parents tried to pay tuition online, only to be met with error messages. Grocery stores in Miami were limiting purchases of essentials, bread, milk, eggs, because credit and debit payments were failing. People began hoarding whatever cash they had, but as everyone tried to withdraw simultaneously, ATM machines began running dry. In Houston, a young couple trying to buy a used car was told their loan application could not be processed. All banks are freezing large transactions until the market stabilizes, the officer said. Their dream of reliable transportation was paused indefinitely. Across the country, stories like this repeated: mortgages, utility bills, and auto payments delayed, leaving ordinary Americans scrambling to adapt. But while the crisis escalated in the streets behind closed doors, American banks and the government were moving at unprecedented speeds. Emergency task forces coordinated between the Federal Reserve, major banks like JP Chase, Bank of America, and Citibank, and key tech companies that handled electronic transactions. Their mission: stabilize the system before panic reached an irreversible tipping point. Even then, the ripple effects were unavoidable. Credit card networks such as Visa, MasterCard, and American Express implemented temporary restrictions to prevent fraudulent charges or system overload. Some merchants, unaware of these restrictions, turned away customers, creating confusion and anger. Meanwhile, automated trading systems across Wall Street had to be paused to prevent further market destruction. In the suburbs of Philadelphia, retirees watched in horror as their stock-based retirement accounts lost tens of thousands of dollars in a matter of hours. Their lives, planned around careful investments and stable markets, were suddenly unpredictable. Panic spread quickly, not just because of the financial loss, but because trust in the system had been shattered. Back in New York, I found myself speaking to a small group of anxious Americans who had come to a branch for answers. Their questions were practical. When can I access my money? Can I still pay rent? Is my mortgage safe? Bank tellers answered honestly. The situation was fluid, and even they didn't know the timeline. The uncertainty was worse than the numbers themselves. Fear thrives on uncertainty, and in this case, uncertainty was everywhere. By the second day, the consequences of the 50% stock market crash began to show in broader society. Gas stations limited credit card transactions. Grocery stores rationed supplies. Supply chains that rely on constant financial flow slowed to a crawl. Even online platforms experienced disruptions as payment gateways struggled to handle the surge of transactions when people attempted to use alternative methods. Cities like San Francisco and Seattle, reliant on tech-driven economies, faced a unique kind of paralysis. Startups could not pay salaries, venture capitalists froze investments, and software companies halted operations. The digital economy, usually fluid and instantaneous, was now as rigid as the frozen bank accounts themselves. Amid the chaos, Americans started adapting, improvising in ways few could have predicted. Some reverted to cash, bartering, or personal IOUs. Communities in Atlanta and Denver organized local networks to help families access essential goods, proving resilience in the face of systemic collapse. But these were stopgap measures. The backbone of the U.S. economy, banks, credit cards, electronic payments, was exposed as fragile, and Americans saw just how much their daily lives depended on these systems functioning smoothly. By the third day, government intervention began to show results. Emergency liquidity measures provided temporary relief, banks partially restored digital transactions, and stock markets implemented circuit breakers to prevent further catastrophic drops. But the psychological impact lingered. Americans now had a tangible understanding of just how vulnerable the system could be. Trust, once broken, isn't easily rebuilt. In Manhattan, I returned to the same bank lobby where the story began. Lines had shortened, and some digital systems were back online. People were cautiously withdrawing cash, checking balances, and reestablishing their routines. But the air was different, tense, wary, and infused with a newfound respect for the fragility of modern finance. As the markets stabilized in the following weeks, Americans began reflecting on lessons learned. Emergency cash reserves, diversified investments, and awareness of financial systems became hot topics nationwide. News outlets ran stories on how to protect oneself from holding more cash to understanding bank insurance protections. Social media discussions centered not just on lost losses, but on survival strategies. And yet the underlying lesson remained clear. Even in 2025, with all the technology, regulation, and safeguards, a massive stock market crash could paralyze the United States almost overnight. Cities like New York, Los Angeles, Chicago, Houston, Miami, Boston, and San Francisco were not just economic centers, they were the lifeblood of everyday American lives. When the system faltered, lives faltered with it. So, what can Americans do if such a scenario ever occurs again? The answer is a combination of preparedness, diversification, and awareness. Having emergency funds in cash, understanding multiple payment methods, keeping critical financial documents accessible, and maintaining diversified investments are all crucial. And perhaps most importantly, staying calm, rational, and informed is what allows Americans to weather even the most extreme financial storms. By the end of this crisis simulation, Americans learned something few truly appreciate. The stock market isn't just a Wall Street concept, it's intertwined with the daily rhythm of life. When it falters, the impact is felt from your city council to your kitchen table. And while the immediate panic subsides, the memory of vulnerability leaves a lasting impression. As I walked through Times Square that week, the city was alive again. The ATMs worked, stores reopened, and digital payments resumed. But Americans carried a collective understanding that their financial safety net, while strong, is not infallible. And this knowledge, as uncomfortable as it is, empowers citizens to plan, protect, and survive. Before we close, here's what I want from you. Comment below what you would do if the US stock market crashed 50% overnight. How prepared are you? Share your city, your story, or your financial strategy. And if you found this deep dive valuable, smash that like button, subscribe to Mr. Oblivion, and turn on notifications. This is the type of content that empowers Americans with knowledge to face the unexpected. Because one thing is certain, in the modern financial world, no one is immune, and preparation can mean the difference between panic and control.